In 30 years, you'd be looking at around $1.5 million, and that's the true power of compounding.
$1 million.
They got index funds for everything. They got the S&P 500 index fund,
Index funds.
the total stock market index fund,
Index funds.
real estate index funds,
Index fund investing.
bond index funds,
Index fund investing can make you rich.
mid-cap index funds, small-cap index funds, large-cap index funds. I could go on forever.
But how do you know which index funds to invest in when there are so many to choose from?
Index funds.
If you're not investing in index funds, you're leaving serious money on the table. These are some of the simplest, safest, and most powerful wealth building tools available to everyday people. In this video, I'm gonna break down the 5 best index funds that can make you very rich over time, even if you're starting small. We'll cover exactly what each index fund invests in, how much they cost to own. We're gonna talk about real examples of how your money could grow over 10, 20, or 30 years, and which funds make sense depending on where you invest, whether you're in Vanguard, Fidelity, or Schwab. Stick with me until the end because I'll also explain how you can combine these funds into a beginner-friendly portfolio that works for the long term. If you want to take control of your finances and build wealth step by step, you're in the right place. Make sure you like this video and subscribe so you don't miss any future breakdowns.
All right, that's enough suspense. Let's get into it.
Let's talk about fund number 1, the Global X Robotics and Artificial Intelligence ETF, or BOTZ. We're starting with something a little different. The fund focuses on companies in robotics, automation, and artificial intelligence, industries that are expected to grow rapidly over the next few decades. Think about manufacturing automation, healthcare robotics, self-driving technology, and artificial intelligence platforms. BOTZ currently holds around 40 to 50 companies from all over the world that are leading in these areas. That means instead of trying to pick one winner in the AI space, you can buy all of them all at once through this single ETF. Now let's talk about costs. BOTZ has an expense ratio of 0.69%. That means if you invest $10,000, you'll pay about $69 per year in fees. That's much higher than broad market index funds, but it's common for thematic ETFs that target specific industries. The upside here is really just the growth potential. For example, if robotics and AI continue expanding at double-digit annual rates, funds like BOTZ could see significant long-term returns. And the trade-off is higher volatility, meaning the price can swing more compared to a broad market index. So who is this for? BOTZ isn't meant to be your core holding. Instead, it's more of a satellite investment or a smaller piece of your portfolio that gives you exposure to a fast-growing sector. A common approach is keeping something like 5 to 10% of your investments in a thematic ETF like this, while the bulk of your money stays in more diversified index funds. Here's a quick question. Would you be comfortable adding a fund like this for your growth? Or would you stick only to broad market funds? Let me know in the comments. I'd love to hear your approach. Now let me move into the core funds that can make up the foundation of your wealth. Let's talk about fund number 2, or the Vanguard S&P 500 Index Fund, VFIAX or VOO. This is the classic Vanguard S&P 500 Index Fund, which you'll see is either VFIAX if you're buying the mutual fund, or VOO if you're buying the ETF version. This fund is considered the gold standard for index investing, and it tracks the 500 largest publicly traded companies in the United States. These are the giants of the US economy, like Apple, Microsoft, Amazon, Google, and hundreds more. When you invest in the S&P 500, you're instantly getting exposure to about 80% of the entire US market. That means you're diversified across technology, healthcare, energy, consumer goods, and even more. Now let's talk performance. Historically, the S&P 500 has returned about 8 to 10% per year on average. In some years, it's up even more, 20% or even 30%. But other years, it could also be down by 20% or more. Over the decades, the average has been very consistent though. Here's why this matters. If you invest just $500 per month into the S&P 500 and earn an average of 9% per year, in 30 years, you'd have about $750,000. If you double that to $1,000 per month, you'd be looking at around $1.5 million. And that's the true power of compounding.
$1 million.
The costs here are going to be pretty important. So Vanguard charges an expense ratio of 0.04%. That's $4 per year for every $10,000 invested. Compare that to actively managed mutual funds, which often charge 0.5% to 1%, or $100 per every $10,000 invested. Over decades, those savings make a huge difference. If you want one simple fund that can really carry your portfolio, the S&P 500 is it. But if you want even more diversification beyond the top 500 companies, that's where our next fund comes in. Let's talk about fund number 3, the Vanguard Total Stock Market Index Fund. Ticker symbol would be VTSAX or the VTI. The Vanguard Total total stock market index fund goes a step further. Instead of just the 500 largest companies, it includes over 3,500 publicly traded United States companies. That means you get the big names like Apple and Microsoft, but also mid-sized companies and small cap stocks that have more room to grow. It's essentially a snapshot of the entire US economy in one fund. What's the expense ratio here? It's just 0.04%. It's the same as the S&P 500 fund, so $4 per $10,000 per year. In terms of performance, the total stock market fund is very similar to the S&P 500. The difference is small cap stocks. So in some decades, the small caps will outperform, adding a little boost. In other decades, they lag, but overall, the two funds track very closely. Here's another example. If you invested $500 a month into the VTSAX for 20 years at an average 9% return, you'd end up with about $270,000. Stretch that into 30 years and you'd cross over $750,000. So what's the difference between the S&P 500 and the total stock market? It comes down to preference. And if you want simplicity and just largest companies, go with the VOO. If you want the whole US market, VTI is a fantastic choice. And here's the good news. If you invest with Fidelity, they have a similar option, Fidelity ZERO Total Market Index Fund, or the VZROX. Fidelity shook up the investing world by launching their Zero Total Market Index Fund. What makes the fund unique is right in the name. There's a zero expense ratio. You pay nothing to own it, and that means if you invest $10,000, you keep every penny of the returns without paying any management fees. The VZROX invests in the entire US stock market, and it's very similar to Vanguard's VTSAX. The main difference is that Fidelity avoids licensing fees by creating their own index. So it's not identical, but the performance is nearly the same. Why would Fidelity do this? It's a strategy to attract investors to their platform. Fidelity makes money in other ways, like brokerage services, but as an investor, you benefit because you get a truly zero-cost fund. Here's one thing to know. The VZROX is only available on Fidelity's platform. You can't buy it on Vanguard or Schwab. And if you ever want to move to another brokerage, you may need to sell it, which could trigger taxes if it's in a taxable account. But still, if you're already using Fidelity and plan to stay there, VZROX is one of the best deals available. Zero fees, broad market exposure, and long-term growth potential. So at this point, we've covered US large caps,
Large cap index fund,
and the total US market,
total stock market index fund,
and even a free option.
I could go on forever.
But what about investing outside the United States? That's where our final fund comes in. Fund number 5 would be the Vanguard FTSE, or the All-World Excluding US Index Fund. Ticker symbol is VFWAX or VEU. This fund gives you exposure to over 3,000 companies outside the United States. That means you're investing in Europe, Asia, Latin America, and emerging markets like China, India, and Brazil. It includes both developed countries and fast-growing economies. Why is this important? Because the US won't always outperform forever. Over the past decade, US stocks have dominated, but in other decades, international stocks have done better. By owning both, you're covered no matter which region leads in the future. The expense ratio for this fund is 0.07 or $7 for every $10,000 invested. That's still very cheap for global coverage. Performance-wise, international stocks can be more volatile, especially in emerging markets, but they also give you access to growth opportunities you can't get by investing only in the United States. A common approach is to keep 10 to 30% of your portfolio in international stocks. And that way, if another country or region has a strong decade, you'd benefit. So if you want a simple way to diversify globally, the VEU or the VFWAX is an excellent choice. Now let's bring all of this together. If you're just starting out, you don't need to own all 5 of these funds. In fact, you could build a solid portfolio with just 1 or 2 of them. If you want absolute simplicity, I would choose the Vanguard Total Stock Market or the VTI and Fidelity ZERO Total Market or VZROX. And if you want international exposure, include the Vanguard FTSE All World Excluding US. Ticker symbol is the VEU. If you want growth potential in future industries, add a small percentage to global X robotics and AI. The key here is really consistency, investing a set amount every single month and letting compound interest work for you over decades. That's really the best way to build wealth. So now you're probably thinking, okay, Chris, these funds sound great, but how do I actually buy them? Here's the good news. Buying an index fund or an ETF is very simple. Let's break it down step by step. First, you need a brokerage account. Popular options in the United States include Vanguard, Fidelity, Schwab, and even Robinhood and SoFi are great if you're just starting out. Personally, I recommend sticking with Vanguard, Fidelity, Fidelity or Schwab because they've been around a really long time and they're built for long-term investing. Once your account is open, log in and go to the search bar. This is where you'll type the ticker symbol of the fund you want to buy. For example, if you want the Vanguard S&P 500 ETF, type in VOO. If you want Global X Robotics and AI ETF, type in BOTZ. Each fund has its own ticker, which works like a stock symbol. And that's it. Those are the 5 best index funds that can make you rich over time. The simplest path to building real wealth isn't about picking the next hot stock or timing the market. It's about owning low-cost index funds, investing consistently, and letting compounding work for you over time. If you take nothing else away from this video, remember this. You don't need to overcomplicate investing. A few solid index funds, steady contributions, and patience are more than enough to make you financially independent over the long term. Now, I'd love to hear from you. Which of these funds do you feel the most comfortable starting with? The S&P 500, the total stock market, or maybe a small slice of AI and robotics for growth? Drop your answer in the comments. I would love to hear what you guys think. If you found value in this video, make sure to hit that like button, subscribe for more financial education, and turn on notifications so you never miss an update. Thanks for watching, and I'll see you guys in the next one.
Index funds.